Hi, I'm Ron Eaker, and this is Judith Raneri. We're the portfolio managers for the Gabelli US Treasury Money Market Fund. This week's volatility has been dramatic. Increased fears regarding the spread of Covid-19 have been reflected, with stocks selling off and the flight to quality leading to dramatically lower Treasury rates. The 10-year Treasury yield has fallen from 160 early in the month to touch 125 this morning. In the short end, T-bill rates remained relatively stable, reflecting the expectation for any changes in Fed monetary policy to be gradual in the coming months, biased toward a modest easing. That changed dramatically this morning. The market has begun to price in more aggressive movement by the Fed, with expectations now for 2 and possibly 3 25 basis points cuts by June. There was speculation this morning that the central bank might even act preemptively and cut 25 basis points before their FOMC meeting on March 18th. 3-month T-bills dropped about 9 basis points to a discount rate of 139, and the 6-month bill dropped about 12 basis points to 127. The market has stabilized a bit, and those rates bumped up a couple basis points since, but the market remains very anxious.
So when thinking about where Treasury yields are heading, there are 2 scenarios the Street is considering at this point in time. A best case scenario basically centers on the disease stops spreading in China. Chinese production recovers quickly, and the global spread of the disease slows. Countries with a significant number of cases like Singapore, Italy, Hong Kong, Japan, etc. stop the spread, and other countries keep the contagion to a minimum. In this case, the US GDP loses approximately 0.75% over 2 quarters. Second quarter likely worst due to the lag between parts not shipped from China affecting production here in the United States. If the economy stalls for a month or 2, it can easily restart. Now, as for the Fed, the best case scenario would be that they come in, cut rates by 50 to 75 basis points, likely, as Ron mentioned, from April to the end of the second quarter. A bad case scenario adds significant lost output in other countries aside from China. Chinese production does not recover until the second quarter. The global supply chain disruption is severe, and a global recession appears to be the likely result, unfortunately. Now, in this case, the Fed comes in and cuts the Fed funds band rate from 0 to 25 basis points, keeping it there through 2020 into 2021. Bottom line, the possible outcomes, therefore, range from a mild global recession and a severe U.S. slowdown to severe global recession with a moderate U.S. recession. In both cases, the Fed rate cuts are appropriate, and because the United States economic impact is likely to lag, even in the best case scenario, the low in market rates is likely yet to be seen. Thank you.
Investors should carefully consider the investment objectives, risk, charges, and expenses of the fund before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 1-800-GABELLI or visit www.gabelli.com.